Dear viewers, if you're serious about making money from stock markets and have been curious about how investing works, you're likely to have come across some financial metrics. Some of the most tracked ones are return on capital employed or ROCE and return on equity or ROE, along with PE multiple or price to earnings and profit margin. The first to reflect how much profits a business can generate on the capital invested in it, while PE ratio suggests a multiple that the market is willing to pay for these businesses. Experienced investors rely more on return ratios like return on capital employed and return on equity metrics as compared to some of the widely followed ones like profit margins. That's because while high margins might signal efficiency, a company's ability to generate strong returns on its capital can hint at something deeper, a competitive edge, an economic moat. But there is a twist. Returns do not reflect the full story. Some companies generate strong returns year after year, but with no further attractive avenues to reinvest their earnings. Think of mature industries and players like Castrol, where market demand is saturated in the lubricant industry and growth opportunities are few and far between. These companies often have a legacy moat, a solid base, loyal customers, and reliable profitability, but then they lack the room to grow. They tend to return most of their profits to shareholders as dividends instead of reinvesting for future expansion. Now imagine a company that not only earns strong returns on capital but also has places to put that capital to work again at high interest rates. This is what is called reinvestment mode. Companies with this rare combination, high return ratios on invested capital and sustainable growth prospects, can compound investor wealth over time. They're not just making profits, they're multiplying them. These are the companies that not just look good today but have the potential to look better tomorrow. For such companies, looking at PE multiple alone may not be the right way to assess the potential of the stock. What looks like an expensive PE today may look quite reasonable, even cheap, if the company is indeed able to grow its earnings while maintaining its balance sheet quality and return ratios. So let us look at some of the companies that have this potential, at least from the financial guidance and the numbers that they're reflecting. Do note that this is not an investment advice or recommendation, but just a watch list of stocks where present looks good and future guidance is promising. Each of these companies comes with some inherent risks that you should keep in mind. The first is BLS International, a global player in visa and consular services, helping embassies and governments handle applications, biometrics, and e-visas. It is shifting from partner-run centers to self-managed operations, giving it better control and higher profits. With over $1 billion in contracts coming up for renewal and global tenders in sight, BLS is aiming for 15 to 20% annual growth. BLS International also runs a digital service arm offering e-governance, rural banking service, etc. The business is cash efficient, getting paid before delivering services. BLS is banking on higher revenue per visa, bigger market share, and value-added services to drive growth while keeping profit margins over 30%. Acquisitions are also on radar. However, it faces risks like reliance on tenders, seasonal slowdowns, geopolitical tensions, and potential missteps while going after inorganic growth. The second company on my radar is Heritage Foods, one of the biggest private dairy players in South India. Over the past few years, the company has seen a healthy improvement in margins thanks to a growing share of value-added products like sweets, drinkables, and ice creams. In fact, the contribution from these products has gone up from 26% in FY22 to 32% now. And the management is aiming to push this further to 40% by FY28. The company enjoys strong relationships with farmers for milk procurement and has built a solid presence, covering 75% of PIN codes across 17 states. On the financial front, working capital management has improved notably, and with the dairy industry gradually shifting from unorganized to organized players, Heritage stands to benefit in a big way. Key financial indicators like return ratios, growth, and leverage look quite healthy. But then there are some risks to keep in mind. These include volatility in milk prices, geographical concentration with 90% of revenue coming from just 4 states, and risks related to capital epidemics and regulatory changes. Another point to note is that the family of Chandrababu Naidu holds a stake in the company, so any shift in the political dynamics could potentially affect investor sentiment and stock performance. Now let's move to the third candidate, Transformers and Rectifiers India Limited. This company is a key player in the transformer and reactor manufacturing space in India, operating in a B2B model. It serves sectors like power generation, transmission and distribution, and industrials. The industry is currently riding strong tailwinds thanks to the expanding power grids and rising demand. The company has a robust order book of over rupees 51 billion and has clocked rupees 20 billion in sales in FY25. What more, it's currently negotiating inquiries worth rupees 220 billion. Recently, the company raised funds to fuel its growth and capex plans. It is aiming for rupees 80 billion in revenue over next 3 years and expects to be fully backward integrated by June 2026. That should help sustain its margins. That said, there are some risks that you should be aware of, like client concentration, stiff competition, and potential pressure on working capital. I want to make it clear that this is not an investment advice, just a few interesting names for your watch list if you are interested in candidates with return ratios that look promising as well as with growth prospects that could look good. If you found the video useful, do give it a like and share your feedback in the comment section. Thank you for watching. Goodbye.